There have been lots of column inches devoted to explaining the European Union's emission trading scheme and its proposals for the third phase, which is going to start in 2013. I'm not going to take up your time going through the details of the new rules. We've put together a briefing that does that. What I want to cover is what you can do now to minimise the commercial impact of the rules. The third phase is going to be a much tougher regime, and companies operating in the EU are going to face a double whammy of higher emissions charges and competition from non-EU countries that don't have the same environmental rules. And the net's going to be wider too. The rules will include a wider range of activities and sectors, including any uncovered emissions from the petrochemical sector. Given that the rules are coming, is there a reason to get hot and bothered? Or is the emissions trading scheme simply a cost of doing business? We think the answers are yes and yes. And we think that there are three areas that companies should be looking at. First, business needs to lobby the EU for more certainty on both the decisions and the timetables. Second, as far as compliance is concerned, there are actions that companies can take now to manage the costs and mitigate the business risks. And thirdly, there are other options to consider, such as investing in overseas projects and new technology. They can actually earn money. I'll start with the current EU proposals and timetable. The message that Brussels has been keen for us to hear is that it wants a level playing field for EU industries. And this means that richer EU member states will face stricter targets. On the other hand, others will be able to increase their emissions. But what's really interesting is what Brussels isn't saying, what it's left out, what it's yet to decide, and where it may be hedging its bets. Brussels actually wants to wait and hear the outcome of the post-Kyoto Global Climate Agreement, which is coming in 2009, and it wants to wait for that before deciding on a number of things. For example, it reserves the right to decide who should benefit from free allocation, if anyone should, and how to deal with overseas competitors. And then there's the massive fine detail that's going to make up the final rules, and possibly the country-by-country variations, and they'll determine the true costs for businesses. The current proposals mean that you'll have to plan for the new rules a long time before there's any certainty about those rules, about when they're going to arrive and when they might end. But there is a lot that you can do now. You can look for ways to renegotiate your environmental permits, installation by installation, and in doing that, to make the most of free allocation. It's also important to consider how the new entrant rules might benefit you, as well as considering if there are any grounds for a legislative challenge to allocation and the sort of decisions that will go along with those allocations. In Germany, the challenges in both phases 1 and 2 have been loud and numerous, and our carbon economy team has worked on a number of these cases. And that work has shown that there are quite a few legal issues and angles that can form the basis of challenges of that sort. And finally, as well as lobbying the EU and getting ready to manage the risks and costs, there may be ways to raise revenue from the new rules, basically through carbon trading. The carbon market's growing at an extraordinary rate, and we think that companies should look at the opportunities to trade in their own allowances and to trade in credits from UN-approved projects. While details about the number of carbon credits that can be used for compliance purposes have yet to be finalised, we think there'll continue to be opportunities to raise revenues by investing in UN-approved projects and selling the emissions credits which result from those projects on the open market. It's worth investigating.